it's all of the kind of like microstructure issues. Like it's getting into the weeds. So Dogecoin, um, the perpetuals on Dogecoin have like disconnected from spot violently over the last couple months. You, if you could just like long Dogecoin, short the perpetual, you're making extraordinary amounts of money, and you're market neutral. It's wonderful, and you can run it unlevered. So on paper, this looks like a great trade. Um, you're not going to make 50,000% or whatever, but you can do extremely well. So like, why aren't we doing that? Well, what's your margin? Are you margining this in dollars or in coin? Like, so an inverse contract. If you're margining it in dollars and you've got a short position on, like when Dogecoin goes to the moon, it's going to start sucking up a lot of dollars of collateral. So you've got this like basically like Doge to the moon risk embedded in that trade, which you don't want to take. So you can do an inverse perpetual, which is where the margin instead of being dollars is the margin is the coin. So what happens is you put down one Dogecoin of collateral, you short one Dogecoin's worth of perpetual, and as Dogecoin goes to the moon, your collateral is worth more and more and more, and so your position's always collateralized. So like that's wonderful. Okay, so why don't you do that? Well, Dogecoin can move really, really, really fast, and it can move fast up and it can move fast down. And the problem when it moves down is that when we're stepping into this market, it's to sort of provide that liquidity on the long side for the longs, so on the short side. And if we're doing that, that means there's a lot of people that are probably overextended, levered long on Dogecoin, which is already just worrying. But if Dogecoin, like on SNL, if Elon had said something else and it had tanked, 50% instead of 20% in a couple minutes, which is plausible, um, these guys get taken out. And the way the insurance contracts work on a coin margin contract, so insurance contract, depending on the exchange, will be structured in different ways. But if we look at Binance, for example, which is probably the deepest market for Dogecoin perpetuals, like there's an insurance contract which backs that particular coin's contract. And it's non-recourse to any other insurance contract and non-recourse to Binance's balance sheet. And so if you get a 50% drop all of a sudden and your longs are just getting liquidated, you can blow through this insurance fund really quickly. If that happens, we're long the spot, we're short the contract, we've now made a bunch of money, but all of that money is unrealized P&L in the perpetual. If the contract blows up, our P&L is gone, and we're left with a bunch of worthless Doge. So the more that trade works out for us, the more sensitive we are to basically that counterparty risk, or to being able to get to work our way out of that trade. But you're going to make the money when it drops. When it drops is when the insurance fund loses money, which it's exactly the time at which you need to be worrying about your counterparty risk. And so suddenly now when you start weighing all of this up, you need to look really at the specifics of the contract, the insurance fund, how it works, how much liquidity there is there, what the beta is of that asset, whether there are any kind of risks that would cause, idiosyncratic risks that would cause Dogecoin to go up or down a lot. So you need to be looking at the market. It's very event driven. You start kind of layering in a lot of things that you need to worry about on this, what started out as a very simple trade that you could set and forget, like buy Doge, sell perpetual, go to sleep. And so as we kind of work our way kind of deeper and deeper and deeper into all of these trades, it's really kind of a multiplicative effect of lots of small risk nuances that you need to think about that you don't need to think about in the traditional space. And that's why I think,
you're doing it in Binance. That was just Binance, right?
so that's just Binance.